Hi everyone. So today in this session, we are going to start with a new area and one of the most important areas for the exam. Name of the concept is currency swaps. Totally in this particular area, seven different types of questions I have compiled taken from the study material RTPs. So in regard to the study material, there is only one question in this, but RTPs I found around 6-7 questions. Totally I kept around 7 questions in the module. In this particular material, I have already shared this in the Telegram group. This will contain good amount of questions on currency swaps which require you to clear examination questions. If a question comes in examination regarding the currency swaps, how to tackle, understanding the logic, everything we can see with the help of these 7 different examples that we are going to tackle in the uh, video regarding the currency swaps. Next, I will be dividing this currency swaps concept into two parts. First 4 problems will be one lecture. Next 3 problems will be another lecture. That 3 problems contain next 3 problems will be calculation of valuation of the swaps and arbitrage. And the first 4 questions will be on understanding how the swaps operate with the help of some exam questions. Like parallel loan concept is there. Second concept will be the transformation of swap assets and transformation of swap liability. Those are the two things we are going to see with the help of 4 different types of questions. One question is there. That question was actually taken from a CFA level 3 book called as Braille Mayers. One book is there. In that one question is there. Exactly same ditto question was lifted by our ICAI and kept in one of the recent RTPs. Okay? From CFA level 3 book, they have lifted one question from a book called as a Braille Mayers. Because at CFA level 3 I have seen in the books. So CFA level 3 that question is there. Same question. So numbers also they didn't change. Same type of question, transaction between USA and Japan. One question is there that was lifted and kept in the material. That question I will explain first. With that help of example, you will understand how this currency swaps evolved. Okay? How the currency swap concept has been evolved and why they go for currency swaps. We will understand with that example. Once that is completed, easy questions are there. 4 marks questions will come in examination regarding transformation of assets and transformation of liability. More about this we will understand using the examples. Okay, first, before even starting with this, I will be first explaining you the logic of this chapter. Once you match to the wavelength of this chapter, understanding becomes very simple. Point number 1, companies having cross border trade, cross border loans. What do you mean by cross border trade and cross border loans? Imports and exports is called as a cross border trade. Okay, cross border loans means loan is taken by Indian company, but loan is taken from a company in USA. Means from a bank in USA, Indian company is borrowing, or Indian company is making a investment in the bank deposits of Australia. In both the cases, whether asset creating a deposit or liability creating a borrowing, both are denominated in foreign currencies for an Indian company. There is an exchange risk, also called as a currency risk. So entities which are in, okay, which are in entities which are in cross-border trade or cross-border borrowings or deposits will be exposed to a unique type of risk called as currency risk. To avoid this currency risk, one separate chapter is there which will be discussing about the forex risk exposure. Okay, which will be taking up the forex risk exposure. So whenever I say forex risk exposure management, we have already seen various types of hedging techniques. Popular hedging techniques will be forward hedging, money market hedging, leading, lagging, exposure netting, currency options, currency futures. There is last another hedging strategy called as currency swaps. Called as what swaps? Currency swaps. How this currency swaps market actually works, how the world of currency swaps will work in a real life scenario. Let us try to understand using one example. Before going into that, I will ask you one question, or rather I will only give you the answer. Listen carefully. Maybe people get one doubt. Sir, already there is a concept called as a forward hedging, money market hedging, leading, lagging, exposure netting, currency options, currency futures. So many hedging strategies are there. Na? Then why should I go for currency swap? It's a question which should be answered. Okay, I will give you one example. whenever I go for a forward agreement, what do you mean by a forward rate agreement? Forward rate agreement is a concept where we will be blocking a particular rate today itself. Means today $1 is 83. 2 months after a dollar will be how much? We don't know. We want to make a payment after 2 months. At that time, dollar may increase to 86, 87 also, which will incur a lot of operational loss for the company. It has to pay extra in rupees. Therefore, companies to avoid this peculiar type of risk, they will enter into an agreement called as a forward agreement. What agreement? Forward agreement. Forward agreement is an agreement entered by an exporter or an importer for blocking a particular rate today itself, which has to prevail in future. That's called as a forward agreement. Second, money market hedging. Which hedging? Money market hedging. Money market hedging is a concept where we will borrow in one currency, we will deposit in another currency. Okay, that can be used only if you are an importer or exporter. If you are a borrower or lender in foreign currency, you can't use money market hedging because money market hedging requires borrowing and lending one more time. So double time you can't borrow. Therefore, people who are having intercontinental or inter-country indebtedness will not go for money market hedging. Money market hedging will be more useful only if the payment is made, only if the payment is to be made for import or export. Same even with the case of forward hedging. Forward hedging, you go to the bank today. Once you go to the bank today and ask the banker, please give me one rate. Okay, please give me one rate, forward rate. He will ask, how many months forward? I said 3 months. They will give. They will calculate the swap rate and they will add the swap points or swap tick rates to the existing ask and bid rate, and they will quote me a particular rate. You have to pay 85, like that they will give. Now the question starts. If I want a forward for 6 months, will they give? Yes, they will give. If I want a forward rate for 1 year, will they give? They will try. If I want a forward rate for 5 years, will they give? They won't give. Listen carefully. How the market will be in the next 3 months, I can understand. Using that economic factors, I can quote you one rate for 3 months after for today itself. Means I can quote a rate today to prevail after 3 months. Because 3 months is very near. I can quote at least 6 months okay, 8 months okay, 1 year okay. Beyond 1 year, it will be impossible for the banks to give a forward rates. Give a forward rate. Therefore, whenever I borrow money, I will borrow today but pay the principal after 10 years. When I pay the principal after 10 years, what will be the exchange rate? How will I know today itself? It will be highly impossible for anyone to guess a particular rate to prevail after 10 years. So, it is not practically possible for the business houses to enter into a 10-year exchange rate forward agreement because banks will not generally give that. Now tell me how forward hedging will be useful for you. So, whenever there is a intercompany or inter-country borrowings or deposits, it may not be wise for the companies to go for forward hedging. So, forward hedging is out of question for borrowers and lenders. It is not recommended for them to go for a forward rate agreement or forward hedging contract. Number one. Number two, money market hedging involve borrowing and lending. Already you borrowed and lent. Why again you are going for that? Out of question. Number three. Third one, can I go for leading lagging? Leading lagging is a strategy which will be used when there is a import export payments, okay, and we are going for a exchange forward either preponement or we are going for a postponement, okay. So interest is not a preponed postponed amount here. Bank will tell one date, on that date you have to pay the interest. Therefore, who the hell are you to lead it or to lag it? So out of question again. Okay. Next, currency options and currency futures. Let's go into that. Currency options and currency futures. First thing I wanted to tell you is, whenever I say currency options and currency futures, there is one disadvantage in that. The disadvantage is they are net settled. Means real settlement don't happen in the futures market. When futures market don't go for a real settlement, then how can you really get the dollars to make the interest payment? In reality, you should make the payment in interest. Payment of interest in dollars or in euros or any other foreign exchange. So, in a nutshell, if I have to tell, our normal foreign exchange agreements, what we enter, like forward agreement, money market hedging, leading, lagging, or even for that case, currency options and futures also, I told you the disadvantage. futures are not really tradable. Means what? Really there is no delivery of dollar or euro or any other foreign exchange. There is only a net settlement. When you take a loan, you have to actually pay the loan interest. Actually you have to pay back the principal amount. Okay, for that you can't enter into a options contract. Okay, or even for the futures contract. You may get a question, sir, you are wrong, sir. Futures is net settlement, sir, I agree, but options really deliverable na. Options lo, though there is a delivery, there is a problem. Do you know what is the problem? For each dollar you have to pay a premium. You have to pay a premium. Options premium will be there na. Call option premium, put option premium, you have to pay a premium. Principal amount is $100 million. $100 million if you pay premium, that will be more than your interest cost. Yeah, we should use common sense na, as a financial advisor to the company. So all the concepts whatever we have dealt till now, okay, like forward hedging, money market hedging, leading, lagging, exposure netting, currency options, currency futures, all these do not work if loan transactions are coming into picture. Clear? So when loan transactions are involved, in such case our normal traditional techniques whatever we used in the foreign exchange chapter will not be suitable. When those are suitable? Those are suitable when the transaction is a general import or an export. Then only we can safely use the techniques whatever we have seen in that chapter. Okay, when the transaction is not involving a export or import, but the transaction is a loan transaction and the volume is hyper big, then what we generally do in such case, those agreements do not work. Now you may get one question here. Okay, forward hedging lo, you will block a forward rate. Loan transactions that is difficult because you will pay principal after 10 years. Okay, second, you may ask, sir, for interest I will go for forward hedging, sir. For what? For interest I will go for forward hedging. Interest you can go for forward hedging, no doubt you can go for a forward hedging for a interest payment. In what currency you will pay interest? Dollar currency you will pay if you borrow in dollars. Pound currency you will pay if you borrow in pounds. That means you have to pay that in a foreign currency. But forward hedging, there is a problem. Do you know what is the problem? Whenever you have to pay, you have to buy the foreign currency. You have to buy at what rate? Ask rate. Ask rate is a higher rate. You are always losing a spread. Yeah, bid rate is 81, ask rate is 84. You have to pay at 84. There is a spread loss for you of 3 rupees for each dollar. 1 crore dollars means you are losing how many crores? 3 crore rupees company is losing just on the ask bid spread for every interest payment you are making. Semi-annual payment means you are going to lose it 2 times in a year. Quarterly payment means 4 times you are going to lose. Monthly interest payment at 12 times you are going to lose. One time interest you are going to lose a huge amount once in a year. Therefore, companies do not go for forward hedging most of the times when the transaction involved is a financial transaction, not being an export or an import. Okay, now forward hedging no, money market hedging no, leading, lagging out of question. Okay, next one, currency options and futures. I told you what is the problem with that. So out of all these, there is a difficulty when the company is having a borrowing and lending. When the company is having what? Borrowing and lending, all these techniques proved to be useless for the companies. Okay, last, sir, why useless, sir? I can go for forward hedging na. Just now I said na, forward hedging problem. No problem, sir, I will pay at ask rate. I will pay at ask rate. Let us go for forward hedging for interest payment. Principal payment na, whatever we can do at that time we will do after 10 years. Like that you may get a doubt. But the question is, shall I tell you, what if you are allowed to pay in your home currency? Question understood? What if you are allowed to pay in your home currency? What is my home currency? Rupee. What is the loan payment module? Loan payment is moduled in dollar. Means you have to make the payment of interest in dollar. You have to make the payment of principal in dollar. That means you have to make the payment, 2 payments, interest payment every year, principal payment at the end. You have to make the payment in which currency? Foreign currency. What if you are given a chance to make the payment in rupees directly? Then you are not exposed to currency risk. Na? How to do? Swap transaction started. You are talking about forward hedging, money market hedging, leading, lagging, exposure netting. Oh, so many things you are speaking. Na? In all these, there is one thing common. Do you know what is that one thing common? Conversion. What conversion? rupee into dollar and making the payment. Receipt na dollar into rupee and taking the receipt. Conversion is there. In all these examples, there is a conversion. Asal conversion if I can avoid, how it look like? From there, the ideology of swap started in this world. Okay, the primitive way of swap is called as a parallel loan transaction. Primitive way of swap is called as what? Parallel loan transaction. One thing everyone listening to this lecture should understand: why currency swap? This is the intro. All the previous techniques we discussed will not be useful when there is a loan transaction involved. What transaction? Loan transaction involved. Therefore, there should be one alternative for all these things. Okay, you borrowed already in dollar. If I can convert my dollar borrowing into rupee borrowing, how it look like? From there, currency swap concept started. Okay, currency swap is not the swapping of interest rates, is the swapping of the currencies, is the swapping of currencies. But there is a difference between interest rate swaps and currency swaps. What is the difference? How it is going to impact? How we need to understand? That's all we are going to discuss in the first four problems. If you understand the first four questions on currency swaps, I'm going to discuss in this lecture. Okay, 70% chapter done. After that, I will do two recent RTP question. This attempt RTP and last attempt RTP. Both RTPs are having currency swaps question. I will solve that. That's all. You will have a clear mindset with regard to doing the problems regarding the concept called as currency swaps. Shall we start? Here. This document I already shared in the Telegram channel. First, let us understand. To understand this chapter intent, let us first have a numerical example. Introductory question is taken from the book because I don't want it to steal anyone's credit. I should give credit to that person. A fantastic question is there. I have taken from that because I am at CFA level 3. In that one booklet, I found this Braley Mayer's one very very popular CFA level 3 book. In that they have given one question on parallel loan. Question on parallel loan. Same ditto question was lifted by ICAI also very recently. Okay. Braley Mayer's booklet, there is one introductory question. I am going to discuss about it. Next, parallel loan arrangement. What arrangement? Parallel loan arrangement. Sir, one thing I wanted to tell before we begin with. Forward, money market, leading, lagging, exposure netting, currency options, currency futures, in all these, one thing is common. What is that? Conversion. Conversion of what into what? Home currency into foreign currency for payments, foreign currency to home currency for receipt. అసలు కన్వర్షనే ప్రాబ్లం ఫర్ మీ. ఐ డోంట్ వాంట్ టు కన్వర్ట్. ఐ వాంట్ ఎవ్రీథింగ్ టు హ్యాపెన్ ఇన్ మై కరెన్సీ సచ్ దట్ ఐ డోంట్ ఈవెన్ హ్యావ్ ఏ ఎక్స్పోజర్ రిస్క్. యా, in that there is only one possibility, and that possibility is the currency swaps. No sir, I don't want this. Then you go for any of these, you will get a big loss, you can cry. Okay, let's see. Companies having cross border trade or loans have a specific risk called as currency risk. So companies can go for hedging: forward, money market, leading, lagging, exposure netting, currency option, currency. All these we already completed. We are going for the currency swaps. Now we are in the last hedging strategy, currency swaps. Let's take one question. This is a question taken from Braley Mayer's. One very good question as to understanding how swapping has done initially 1960s and 70s. Okay, how it is done. One exam question is, sorry, one question is the exam question in CFA, one RTP question in CA final. Let's read. McDonald's hamburger company wishes to lend $5 lakh to its Japanese subsidiary. At the same time, Yasufuku Heavy Industries is interested in making a medium term loan of approximately the same amount to its US subsidiary. I call it as D Limited of USA. I will call this as Y Limited of Japan for understanding. The two parties are brought together by a investment bank for the purpose of making parallel loans. McDonald's will lend, I mean D Limited will lend $5 lakh to US subsidiary of Y Limited for 4 years at 13% interest. Principal and interest are payable only at the end of 4th year, with interest compounding annually. Y Limited will lend the Japanese subsidiary of D Limited 70 million yen for 4 years at 10%. Again, the principal and interest are payable at the end. That means no interest will be paid in the medium term. Today I will take the loan, 4 years after along with interest I will pay. That's the agreement. Current exchange rate 140 yens. Current exchange rate is 140 yens to the dollar. However, dollar is expected to decline by 5 yen to dollar per year over next 4 years. If the expectations prove to be correct, what will be the dollar equivalent of principal and interest payment for Y Limited at the end of 4 years? And for the uh, T Limited also we have to calculate. Which party is better off with the parallel loan arrangement? What would happen if N did not change its value? Calculate the break even future spot price. These are the 4 questions that they tested on this particular area. If this comes in exam as it is, okay, by God's grace, if it come, it will be given at least for 8 marks to 10 marks in exam. Okay, first read the question before we start with the solution. Again, I'm telling you, just spend 1.5 hour on this. That's all. You are done with this chapter. You can directly go with the other chapters for your preparation. Okay. Done with reading the question. Let us understand. What they are saying is, four companies are there. Roughly, I will first do. How many companies? Four companies. Okay. Now, D Limited, USA, Y Limited, Japan. Y Limited in Japan has a US subsidiary of Y Limited. Japan subsidiary of D Limited. D Limited wanted to give. D Limited wanted to give. See here. $5 lakh. $5 lakh. This person wanted to give yens how much? 70 million. This is the transaction. Now you tell me the answer. They will first lend money. Who will lend? Intercompany indebtedness will be there. That means holding company in USA wanted to give loan of, okay, $5 lakh to a Japanese subsidiary. Okay, means what they have to do? They have to convert this $5 lakh into yens and give it to Japan. Japan subsidiary interest and principal will be paid back by converting yens into dollar at that time. 2 times conversion happens. Next, same happens also with the Y Limited in Japan. Y Limited in Japan will give loan to the US subsidiary of Y Limited. Yens will be there, that will be converted into dollars and they will give. Again, that dollars will be reconverted into yens along with interest. US subsidiary of Y Limited will pay to the Y Limited. Again, 2 conversions happened. Okay, this is the original transaction they wanted to enter. Understood? This is the original transaction they wanted to enter. So now what we have to understand, they wanted to lend $5 lakh to Japanese subsidiary, and Japanese company wanted to lend 70 million yens for the US subsidiary of Y Limited. This is the original transaction they wanted to create. Okay. Now, one intermediary started there. Both the companies are brought together. Okay, there is one intermediary, one moderator, one person is there in the middle. This person said that D Limited, you need not give dollar converted yens loan to Japanese subsidiary. Y Limited, you need not give yens converted amount of loan to the US subsidiary. You don't convert, you also don't convert. You do one thing, I will arrange in such a way that D Limited of USA will give loan to Y Limited's subsidiary in USA. Y Limited of Japan will give loan to Japan's subsidiary of D Limited. Y Limited in Japan will give loan to the Japanese subsidiary of D Limited, such that you pay to him in dollar, you pay to him in yens. In such a case, there is no currency conversion at all. That means a concept called as a currency risk will be totally negated. This is what they wanted to create. Okay, to sum up the entire transaction, see here. See the diagram clearly. M Limited of USA decides to give a loan of $5 lakh to its Japanese subsidiary, and Y Limited of Japan wanted to decides to give a loan of 70 million to its US subsidiary. Okay, so point is, instead of M Limited giving loan, okay, giving loan to M Limited Japanese subsidiary by converting these $5 lakh into yens, and Y Limited, instead of converting these yens into dollar, the intermediary has made one arrangement. Intermediary has made one arrangement. What arrangement they have made? They said that M Limited, don't do like that, do like this. See the arrangement there. What arrangement they wanted to do? M Limited decides to give loan to the Y Limited's US subsidiary at 13% interest for $5 lakh. Okay, next. Y Limited in Japan will not give loan to its a subsidiary in USA, it will give loan to M Limited subsidiary in Japan directly in which currency? Yens. So, in such a case, what will happen? M Limited in USA will lend in dollar, Y Limited in Japan will lend in yens. Conversion concept does not arise. Means which risk is negating means completely taking out. Which risk is negated? Negation of currency risk. Currency risk is not there. This is the first point I wanted to tell, because payments are made by this company to this company in dollar. Loan given in dollar, loan taken back in dollar. There is no foreign currency involvement. This is how they can do. This concept is called as a parallel loans. You give loan to my subsidiary in your country, I give loan to your subsidiary in my country, such that foreign exchange risk, typically what we call as a currency risk, does not arise. That's what I have written here. See here. Due to this arrangement, there is a savings in interest conversion and also the principal conversion. See the original, how clumsy the original transaction is. M Limited will give loan to them. Okay, M Limited will give loan to them. This person will convert yens to dollars and then pay to them. So many conversions will come. To avoid all these conversions, we can make a parallel loan arrangement. Parallel loan arrangement is an arrangement where my company will give loan to your subsidiary in my country, your company will give loan to my subsidiary in your country, such that there is no need for conversion of foreign currency or home currency. In such a case, you don't have a risk called as a currency risk. This is the first primitive way of currency swap transactions happened in the world. What is the name of the concept? Parallel loans. What is the parallel loan? But some observations before we start with. Okay. Okay. Now see here. What is this spot rate for a dollar? $1 equal to rupees, yens 140. $1 equal to rupees, yens 140. Now the question arises. Observations required here. This is very important. Okay. Always, whenever we start the swap transaction, there will be convergence. Meaning of this convergence, I will tell you. Before that, first listen to the concept. Okay. Whenever a loan transaction, swap transaction or parallel loan transaction is initiated, no company should be at an advantage, no company should be at a disadvantage. Are not understanding. I will explain one point. See here. How much money US company wanted to lend 5 lakh? How much money, or I will write full, 5 lakh. How much money Japanese company want? Yen's 70 million, na? 7 crores. 7 crores. This loan transaction should be matching. Loan transaction should be matching. What do you mean matching? This parallel loan transaction is possible. I repeat, this parallel loan transaction is possible only if no one should be at a greater advantage, no one should be at a worst advantage. Means both of them should be equally placed in the agreement. What does it mean? I will give you an example. How many dollars I wanted to, delimited wanted to give? 5 lakh. 5 lakh into, what is the exchange rate between these two? 140. 5 lakh into 140 you make, it's a 7 crore. That's how that 70 million concept came. Are you understanding? Means my 5 lakh dollar is as good as 70 million yens. Yeah, that means you wanted to give 70 millions, na? You do one thing, I will give them 5 lakh. 70 million equivalent you give to him, or else what will happen? I will give 5 lakh dollars to him. If you give them 55 lakh yens, I am giving more loan to them. Are you understanding that? I'm giving more loan to them. You are giving a lesser loan. Means my risk is more, your risk is less. Or I will give 5 lakh yens, 5 lakh dollars to your subsidiary. You give, say for example, 80 million yens to my subsidiary in your country. Means then NC payment is more, dollars payment is less. Then the advantage is more on the dollar side. Therefore, always parallel loan arrangement, whenever you enter, no party should be given an advantage. No party should be given an advantage. But this advantage negation or something like convergence, no one should be at an advantage. This convergence, both are equal, is called as a convergence. This convergence can be there only today. At the time of initiating the loan transaction, a convergence will be seen. But once the loan is given, exchange rates are not in our hand. Are you understanding or not? Exchange rates are not, it will fluctuate. But delimited or M limited, delimited, M limited or delimited, whatever the case may be. Yeah. McDonald's, na? That's why I've written M here. Sir, M or D, whatever the case may be. Sir, McDonald's, na? M I kept here. Okay. So this M limited of USA, it will give loan or not? Yes, it will give loan. It will give loan to its subsidiary. It will give loan to the Y limited subsidiary in USA. Y limited subsidiary in US, it gave a loan. How much loan? 5 lakh, 13%. I gave your subsidiary 5 lakh, na? You give equivalent amount to my subsidiary. What is equivalent amount? Convertible 140, 70 million. That's how that 70 million point came in the question. So that's the interpretation of that 70 million. Why only 70 million question will arise? This is the reason. So both the parties should be given equal footing. No one should be having more advantage. No one should be having a bad disadvantage. Over. Understood to here clearly? Now, payment is made by this company to this company in dollars. Payment is made by this company to this company in yens. There is a conversion, no conversion, no conversion. But for comparison sake, what sake? Comparison sake. Listen to my words clearly. But for comparison sake, who is having a better advantage at the end? At the beginning, spot rate is there. But at the end, one party will be definitely at an advantage, one party will be definitely at a disadvantage, because today's exchange rate of 140 will not be the same even after 4 years. 4 years after, exchange rate will change. What change? Exchange rate will change. How to understand that? See the question, see the answer. First, maturity proceeds for Japanese company if dollar depreciate. He asked 4 questions. If expectations prove to be correct, what expectation? See here, dollar is expected to decline by 5 yens to dollar per year over next 4 years. Means what? $1 equal to yens 140. Dollar will depreciate 5 yens for every year. Means 1 year, 2 year, 3 year, 4 year. 1 year after, dollar to yen is 135, 130, 125, 120. So after 4 years, how much will be the dollar yen value? $1 is not giving 140 yens, it is giving only 120 yen. Dollar lost its value. Previously, 4 years back, $1 can pay or $1 can buy $1 can buy 140 yens. Now it can buy only 120 yens. That means yen appreciated and dollar depreciated. In this case, comparison sake, we are doing these calculations. That's why he said dollar equivalent of principal. Okay, interest payments to Y Limited at the end of how many years? 4 years. So tell me, Y Limited. Okay, if these expectations prove to be correct, what will be the dollar equivalent of principal? Dollar equivalent of principal and interest payment to Y Limited at the end of 4 years. Tell me, $1 equal to yens how much? 120. I need to pay how much? Y Limited has to pay how much? Means Y Limited's payment represents what? Y Limited has given a loan to the US subsidiary. Given loan to US subsidiary. How many millions yens? 70 million, which is equal to how many crore yens? 7 crore yens were given to that company. How many? 7 crore yens were given to that company. Yens 7 crore. This 7 crore will be the value along with interest we have to pay along with interest. N interest rate is how much? N interest rate. It was given in the question. 10%. 10%. For how many years? 4 years you have to pay. 1.1 into 7 crore. It will be N's 10 crore 24 lakh 87,000. How many dollars equivalent it will be? Divided by 120. $8 lakh 54,058. This is the dollar equivalent of payment. Dollar equivalent of payment that will be made by the US subsidiary in Japan. That will be paid to the Y Limited in Japan. Okay, simply to tell, this will pay to him actually not in dollars. Say it will pay, but for comparison sake, if you wanted to see that amount in terms of dollar, it is paying how many dollars? 8 lakh, where I have written 8 lakhs 54,050. Let us see the same. What is the total dollar D Limited will receive, or M Limited in our example will receive at the end of 4 years? Okay, tell me, M Limited has given how many dollars? 5 lakh dollars. 1.13 power 4. 5 lakh in 1.13 power 4 into 5 lakh. Dollar 8 lakh 15,237. 8 lakh 15,237. So technically tell me now. Cost. US subsidiary equivalent dollars. Okay. And Japanese subsidiary. This is in USA already. So tell me, they are paying 8,15,237. This one is paying $8,54,058. From this, what you have to understand, who is having a heavy payment, who is having a lesser payment now. One party is having a lower payment, equivalent amount of lower payment. Who is that person? Japanese subsidiary which is in USA is paying $5 lakh. Okay, $5 lakh, 5 lakh they don't pay. 5 lakh into interest they will pay. So their net cost will be 8,15,237. To compare dollar, you can't compare dollar with yens. So we have to compare dollar only with another dollar. Therefore, for understanding, for comparison sake only, US company's subsidiary in Japan, its yen payment we converted into dollars. Okay, for checking purposes. So net they paid how much? 8,54,058. Now you tell me, if dollar depreciate by 5 yens every year, who is having a better advantage? Who is having a worse situation? US subsidiary in Japan will be having a worse situation. Japanese subsidiary in USA will be in a better situation. Okay, this reason also I can tell. Do you know why? Japan company is having a lower interest of 10%. Okay, lower interest of 10. US company is having higher interest of 13%. Foreign exchange chapter you might have already learned. Countries having higher exchange rates. Countries having higher exchange. Sorry, I'm very sorry. Countries having higher interest rates will having a depreciation in foreign exchange market. Okay, US may have 13% interest. Interest 13%, it is winning. But when it comes to the exchange market, US will lose against yens. Same thing happened also here. You are making high payment than a Japanese subsidiary. At the beginning, your 700 lakh, at the beginning your 7 crore yens, my 5 lakh dollars, both are same. No one is having higher advantage, no one is having a lower advantage. Okay, but at the time when the time passing by, exchange rates will not be stable, they will change. If it changes to 120 at the end of 4 years, then we will be having a better of situation. You will be having a better off situation. Y Limited in Japan, Japanese subsidiary in USA is having a better off because it will be paying only 8,15,237 for its yen conversion into dollars. Okay, this is situation. That's the first question, and second question is asking. See here what he asked. If expectation proved to be correct, what is the dollar equivalent? That's why they have given dollar equivalent. Really, US subsidiary in Japan will pay to Y Limited in Japan in yens only. Comparison, who is winning, who is losing in terms of dollars, we calculated equivalent amount of dollars. Okay, next. What total dollars McDonald's receive at the end of 4 years from US subsidiary of Y Limited? For that, why they didn't use dollar equivalent? Already it is in dollars. Yeah, you need not convert. Which party is better off with a parallel loan arrangement? Okay, which party is better off if in the parallel loan arrangement? What would happen if the yen do not change? 140 is at 140 only. Yeah, then what will happen? Interest market lo who is winning? USA. If exchange rate don't change, again who will win? USA will win. In that case, answers will reverse. What will happen? US subsidiary, Japanese subsidiary. US subsidiary in Japan, Japanese subsidiary in US. Okay, tell me. It is not 120, it is 140. See here, I am erasing this. It's 140. Tell me now. 10 crore 24 lakh 87,000. 10 crore 24 lakh 87,000 divided by 140. It will be 7 lakh 32,050. 7 lakh 32,050. 7 lakh 32,050. This will be the payment made by whom? This will be payment made by whom? US subsidiary in Japan. US subsidiary in Japan will pay in yens. These many yens. Equivalent amount of dollar will be dollar 7 lakh 32,050. This anyway will not change. Okay, because we are not in a converting. So in that case, who will win? US subsidiary will win. So really, these conversions happen. Once you made parallel arrangement, US subsidiary borrows in dollars, Japanese subsidiary borrows in yens. Payment is made by first company in dollar to a dollar country. Yen by yen country, there is no conversion. Comparison sake only we are doing this question. So parallel loan question whenever comes in exam, really conversion don't happen. But they will ask if conversion is there, who is having a better situation. Are you understanding the point or not? Now we completed one part. So how many questions we answered? 3 questions we answered. Who will be having the better position? What will be the US company's Japanese position? Japanese company's US position? Who will be having a better position? If exchange changes, exchange rate do not change. Okay. What is the break-even maturity future spot price? Very interesting question here. Now tell me, if exchange rate is 140, who is winning? Exchange rate is 140. US subsidiary in UK, Japan is winning. If exchange rate goes to 140 by declining dollar, who will 120? Who will win? Japanese subsidiary in USA will win. No one should win. Yeah. Again, both should be in an equal footing. Break even, both should be there. In that case, what should be the rate? IRPT forward rate. IRPT forward rate. IRPT forward rate don't give a chance of any arbitrage. For example, $1 equal to yens 140. Let us assume this is a direct quotation. In a direct quote, what will happen? Per unit will be foreign currency, number of units will be home currency. Yen interest rate 10%. Dollar interest rate is 13%. $1, you invest for 1 year. 140, 140, you invest at 10%. After 1 year, what will be the exchange rate here? Or 4 years after, tell me. What will happen after 4 years? 4 years, it has to take the interest rate now. 1.13 power 4. Dollar 1.63 equal to 1.10 power 4 into 140. Yens 204.97. $1 equal to yens 125.75. 125.75. If 125.75 prevails on the fourth year, what will happen? $1 equal to yens 125.75. I need to pay in yens 10 crore 24 lakh 87,000 I need to pay. Means equivalent how many dollars I need to pay? 10 crore 24 lakh 87,000 divided by 125.75. I will pay 8 lakh 15,006 rupee. 8 lakh 15,006 dollars. It is 8 lakh 54,000. 8 lakh 15,000 237 we got. Here we got 006. That is because of the rounding of element. Now you have to understand clearly. Japanese subsidiary will pay in 8 lakh 15,000. Japanese subsidiary in USA, anyway you need not convert, it pay in dollar 8 lakh 15. Here also US subsidiary will pay how much? 8 lakh 15,000. That 237 is only because of the rounding of error we are doing in the IRPT forward. In all other remaining cases, what is happening? US company in Japan is paying equivalent dollars of 8 lakh 15. You are also paying 8 lakh 15. No one is good, no one is bad. No one is advantageous, no one is in the disadvantage. That means if the exchange rates after 4 years are as per IRPT forward, no company will be in a worse situation, no company will be having a better situation. This is all the subject matter of this question here. Okay, I tried to summarize every part in this particular question. Listen carefully, I will summarize everything. Okay, see here, what is happening in this question? There is a company in USA. That company wanted to give loan to its subsidiary in Japan. Dollar converted into yens, payment time yens converted into dollar. Two conversions happen. Second, Japan there is one company, it wanted to give loan to its US subsidiary in USA. Okay, yens converted to dollar, payment time dollar converted back to yen. How many conversions are happening? Two conversions. They wanted to avoid this. They wanted to go for a parallel loan swap arrangement. Parallel loan arrangement means we are not changing anything. Rather than you giving me the loan, directly, okay, rather than you giving me the loan, US subsidiary will be, sorry, US one company we will choose. That company wanted to give loan to the Japanese subsidiary in US or not. Okay, you don't give to them in conversion. Japan company, instead of giving loan to its US subsidiary, it will give to the Japan subsidiary of US company. US company, instead of giving loan to its Japanese subsidiary, it will give loan to the Japanese subsidiary in USA, such that US company lends in dollars, Japanese subsidiary lends in yens. Transaction over. But for comparison sake, who is winning and who is losing, we wanted to understand. Beginning time both are in a same positions because exchange rate will be as per the spot rate. Spot rate 140 na, $5 lakh will be equal to 7 crore yens. That much amount of loan only they will transact. At the beginning stage, inception of the loan contract, both are having same positions. But as the time progresses, okay, exchange rates will change. If it appreciates, if the dollar depreciates and goes to 120, okay, if the dollar goes to 120, in such case, the Japanese subsidiary will pay in yens to that company. Conversion amount is more for them. Okay, that's what the calculations we have done, and this is the answer. See here, step 1, spot rate 120 $140, exchange rate after 4 years will be 120 because depreciation 5 yens per each year. So market value in yens this much, equivalent market value in dollars is 8. Who will pay this year? Who will pay this 854,058? These many dollars, who will pay? No one will pay. If you tell that someone will pay, it's a wrong answer. Again, you didn't listen to the answer. You didn't listen to the lecture clearly. I am not telling that you will pay 854,058. Okay. M Limited in USA as a subsidiary in Japan. Okay, I will call it M1. This M1 will pay in dollars or yens. Okay, really they don't pay in dollars. But conversion amount for comparison sake only we are taking. Really you will pay this. But on a comparison basis, if you take this is the amount you are paying in equivalent dollars. You are not really paying in dollars. Second, Japanese company in USA. Spot rate how much? 140. Okay, spot rate. If the unchanged, if the exchange rate is unchanged and it stands at 120, payment will be 7,32,050. Market value to the US company. US company will be there now that will receive from Japanese subsidiary in USA that will pay 5 lakh at 13%, 8 lakh 15,237. Notes was given, you can read later. So both are equally placed when if it is as per IRPT forward 125.71, then both the companies will be having same footing. With this, we completed the first model called as parallel loan arrangement. Which arrangement? Parallel loan arrangement. Okay, next. Parallel loan over. Parallel loan, nothing is there. You will give to them, he will give to you. Answer over. But for comparison sake, we will convert into dollars and show how much equivalent dollars you have made when there is a declining, when there is a same amount, and when they will be equally placed. Everything we completed. Okay. Next. Second. Hit the second question now. Now you will have more clarity as to why companies go for currency swaps. Let us see. IBM and HP entered into a currency swap arrangement on 1/2/2022, where IBM will pay 11% interest on the principal of pound 10 million in exchange for dollar interest of 8% on a notional principal of dollar 15 million. Term is 5 years. Derive a swap cash flow from IBM point of view. Given spot rate is 1 pound equal to dollar 1.5. Read the question properly before we start with the discussion. Please read the question properly, or else you can't understand what is happening there. Completed reading the question. Your understanding of this question decides your presentation in the exam as well. Please listen carefully to the concept. Okay, listen. Point number one. Again, I am telling you why we can't go for forward hedging, money market hedging, because of the volume is involved and the time period involved. Here, term is 5 years. For 5 years, no fool will give you forward rate, money market rate, currency options, currency futures. All these will be having expiry within a year. So all the hedging strategies, whatever you have learned till now in the IFM chapter, I mean financial management with the international forex, they are not suitable. Those instruments are not suitable. We need to go for a new search. Therefore, see here, IBM and HP entered into a currency swap arrangement, okay, on 1/2/22, where IBM will pay 11% interest on principal of pounds 10 million in exchange of dollar interest of 8% on the notional principal of $15 million. Term is 5 years. Derive a swap cash flow from IBM point of view. Spot rate is 1 pound equal to $1.5. Again, I am telling you, the inception of a contract, at the beginning of contract, no one will be at advantage, no one will be at a disadvantage. It is proved one more time. 1 pound equal to $1.5. $10 million and $15 million, if you observe, exchange rate is identified in that. So that's the first point. Point number one. So first, let us understand the concept. See here, there are two companies. One is IBM, second one is HP, Hewlett Packard. See here, I will give you one example. Okay, IBM and HP. Lender. IBM has to pay. IBM has to pay. See here, IBM will pay 11% interest on principal. 11% interest on principal. 11% of principal at a rate of how much percent? At the rate of 11% in pounds, 10 million. In pounds, 10 million. Okay. IBM has originally borrowed $15 million. Originally borrowed $15 million. HP has to pay to its lender pounds 10 million. Pounds 10 million. Both are happy or unhappy? First tell me. Both are unhappy. In their existing positions, they are not happy. When they are not happy in their existing positions, then they go for a swap market. If you want, go back to my swaps video in the YouTube. It is available. Okay. Swaps, what I said, originally they do something. They are unhappy with the original whatever happened. Therefore, they will go in search of an alternative in the swap world. What you have taken in the interest rate swaps, what they will do? They will take loan in fixed. Another company will take loan in floating. Existing positions they are not liking. Their fixed will be made into floating in swap market. Their floating will be made into fixed in the swap market. Swap market la they do all the magics. Real market la they can't do because already they have done. Okay. IBM has already borrowed from its lender at $15 million. Okay. IBM is a company in pounds. It borrowed in dollars. There is a currency risk. HP is a company in USA. This company has borrowed in pounds. They wanted to make the payments in dollars. They went in a swap. How swap happened? Let us understand. IBM says that HP, I will pay you. How much? IBM will pay 11% interest on a principal. Notional principal of how much? Pound 10 million. Okay. Pound 10 million. Understand the query clearly. The diagram also I only have given for understanding sake. Okay, see. I will re-explain the transaction one last time and continue. IBM is a company having home currency as pounds. HP is having a home currency as dollars. IBM having home currency pounds. If it borrow already in pounds, problem doesn't come. HP in dollar currency, if it borrows already in dollar currency, there is no need of swap. They borrowed in opposite currencies. Now they are going for a swap arrangement. That means if they have already borrowed in pounds, there is no need of swap. If HP already borrowed in dollars, there is no need of swap again. So IBM borrowed in dollar, which it don't want now. It wanted to swap. How swap works, I will tell you. Okay, see here. What happens is, what you can't do in the real world, you have to do that in the swap world, like what we have done in the interest rate swap. Please go to that video and listen carefully. If you didn't remember this, if you could not do something in the real world, do that in the swap world. You borrowed in fixed, you don't want to now borrow in floating in the interest rate swap market, like that. You borrowed already in pounds. You wanted to negate that swap arrangement, you borrow in pounds. Okay, so this is the point. So what happens is, IBM said that I will borrow. Borrow in what? I will borrow in pounds 10 million. And and I will pay the interest. How much interest on pounds? IBM will pay 11% on a principal of 10. I will pay 11%. I will pay 11%. IBM, okay, and HP. Now what HP said? HP is based in USA, having home currency as dollar but borrowed in pounds. Now it want to borrow in dollars. What you can't do in the real world, do it in the swap world. HP will borrow and pay to IBM. Okay, how many dollars? Dollar 15 million. Dollar 15 million. Notional principal. This is notional principal. Dollar 15 million. At what rate? 8%. This 8% is the required return for IBM. Required return for IBM means that 8% will be used as a PV factor for IBM. This 11% will be used as a PV factor for HP. In the question, they asked to calculate from IBM point of view. So the PV factor should be taken at 8% because it is received by them. Okay. Now you tell me. Point number 1. Entire transaction, if you understand. IBM original loan transaction is in dollars. Okay. HP's original transaction is in pounds. They don't want that position. What you can't do in the real transaction, you do it in the swap world. Swap world, you interchange your positions. Okay. Really, you will borrow 10 million pounds. Really, you will borrow $10 million, or it's a notional amount. It is a notional amount. It is a notional amount. At the end of 5 years, if you remember the forward rate agreements, if you remember IRRM forward rate agreements, I explained recently. YouTube, you might have already listened. There, what I said, whenever forward rate arrangement is entered, that arrangement is different from your real loan transaction. That is different from real loan transaction. Real loan transaction happens with one bank. FRA may happen with a different bank altogether. That amount of interest gain or loss you should apply on a amount. Therefore, we take a notional principal. Okay, notional principal is a real principal borrowed or lent. It is only for application of some percentage on the notional principal. Just to apply the gain percentage or loss percentage, I have to apply on one number. That's why we take a notional principal and apply on that. Really, we will not borrow. Really, we will not lend. Understood the point clearly? So, really, we will not borrow. Really, we will not lend. Okay. Now, listen to the transaction clearly now. Listen. What is this part important? Okay. Currency swaps, interest rate swaps. What is the difference? I will tell you. Or IRRM, forward rate agreement. In a forward rate agreement, notional principal is a amount which will be used to apply gain or loss as a percentage. 5% gain I got. 5% means how you receive 5%. 5% is a percentage. It's not rupee. It's not dollar. I have to apply that on some number. Now for that one notional principal is required. Likewise, here also they have clearly given a notional principal. This 10 million pounds and $15 million really exchanged principal. It's a notional principal. It is a notional principal. Means really exchanged, not really exchanged, not really exchanged. Wrong. Really it will be exchanged. That's the difference between currency swap and all other swap transactions in this world. In CFA level 3, they explain this in a beautiful way, which I try to explain you in the same way. Let us understand this. See here. See here. See the markings I am doing. Today, IBM entered into dollar loan. Okay. From lender, it has taken $15 million. Correct? From lender, it has taken $15 million. So, IBM took loan. Took loan of how much? $15 million. $15 million. It has taken a loan. IBM, its currency is pound, but it took loan in dollars. It took loan in dollars. You may ask a question first. Sir, if that currency is pounds, they can directly take a loan in pounds, sir. IBM home currency is what? Pounds. If home currency is in pounds, go to a bank in your London, you can take a loan from there. Why to take a loan in dollar? A England-based company taking loan in dollar, again going on to swap for 10 million pounds. Why to do all these things, sir? You can directly borrow from the bank. Problem comes this way. IBM is a company based in USA. IBM is a company based in USA having its branch in London, generally when NRIs comes to our country, our home country banks will not be interested to give the loans to them. Okay, why currency swap concepts came in the world, sir? Even in the first question, you should ask the same question. First question also, you should ask the same question. Even in that case, sir, why there is a company called as McDonald's company. Yeah? That McDonald's hamburger company is there. That company is having a Japanese subsidiary or not? Okay. That Japanese subsidiary, why it has to take loan from US holding company? Yeah? It can directly take from a bank in Japan. Nah? Why it is not taking? It cannot. Do you know why? It is a NRI in Japan. American company is having a subsidiary in Japan, means for Japan that company is a NRI. Yeah. Okay, that company is a NRI. Like Apple in India is a NRI. It's not a resident company, na. It's a non-resident. Apple company can't borrow loans from HDFC in Hyderabad. Therefore, there are a lot of restrictions. Like that, this question has to be understood. Listen carefully again and again. When I go into the concept, I go very deep. Okay, and point number one, you should understand the modus operandi. Why concept come is more important. Yeah, complete it in half an hour, complete it in 1 hour. I can complete this in 10 minutes also, but you don't understand anything. Do that. Try to understand the transaction properly first. Why I have to go for swap? Why I have to borrow? I am a person in pounds. Why I have to dollar in? I have to borrow in dollar and again swap in pounds. You can directly take a loan in pounds, na? Why we are not doing? You can't do that because IBM might be a company which is NRI in UK. Therefore, that company cannot borrow in pounds like it can borrow in USA. Okay, it can't borrow. Therefore, it went for a dollar loan from its bank. Means IBM borrowed not from company in UK, it borrowed from company in USA, which is its holding company's country. Okay, from that it borrowed $15 million. $15 million. Okay, next, it don't want that position. So my company is restricted by UK to borrow in pounds. I am having a currency restriction. I am in London here. IBM, US company in London. HP, UK company in USA. UK company in USA. This company is a US company in London. It is restricted from pound borrowing. Okay, HP restricted from dollar borrowing. Therefore, they went for dollar borrowing in their country. They went for pound borrowing in their country. But these two are, IBM is established in USA. Okay, IBM is established in USA, but having its place of business in London. HP, though company belonging to UK, though company it belongs to UK, its branch is in USA. So problem came. Problem came in what way? It has to take a loan in dollar. Company is in UK, but payment of interest and principal has to be made in dollar. Then problem came. What problem? Currency conversion problem came. What they will do is they will enter into a swap. They will enter into a swap. How beautifully swap can be explained? See the screen. It will be confusing a little bit, but if you understand the wavelength, journey will be very simple here. See here. IBM borrowed IBM borrowed 15 million. Okay, $15 million. It is in UK, but borrowed in dollar because UK country is restricting this IBM to borrow in pounds because that is a NRI in their country. Like that, the transaction should be understood. In that case, only swaps are useful. Or else I can borrow directly in London. Why like a fool I will do that in indirect cases? So this is the position. Next, what IBM will do? This $15 million it borrowed. Okay, it borrowed $15 million. IBM will transfer this $15 million to HP. $15 million to HP. Okay. Next. HP will borrow. HP will borrow. How much HP will borrow? HP will borrow 10 million pounds now. HP will borrow 10 million pounds now. It will borrow 10 million pounds from its bank and it will be directly given to IBM. Like this, the transaction happens. Means, though it is called as a notional principal, principal is really exchanged in case of currency swap transaction. in case of currency swap transaction. What is the modus operandi here? In a currency swap transaction, principal is notional principal also is really exchanged. Okay, how I will take loan from USA $15 million and I will transfer it to a company in USA called as HP. Means IBM, HP, two companies are there. IBM home currency is pounds. HP home currency is dollar. It already borrowed in pounds. Since it is in dollar, it wanted to swap in dollar currency. It wants to swap in dollar. So it want to borrow in dollar. How to borrow in dollar? Loan already borrowed by IBM na, that you take. Okay. Next, HP. IBM if you see. IBM already borrowed in dollar, but it want pound. HP borrowed in pounds na. You transfer that to me. Like this swap transaction happen in reality. At the end, what will happen? Let us understand. Okay. At the nutshell, for your clarity sake, see here. Lender, lender. IBM, HP. I will write this way. Origin, subsidiary. Origin, subsidiary. IBM borrowed in dollar 15 million. HP borrowed in pounds 10 million. Okay, pounds 10 million. Understand the transaction clearly. Origin of IBM is USA. Subsidiary is in UK. UK. Origin of HP is in UK. Subsidiary is in USA. We are discussing about IBM in this point of view. Means IBM being a subsidiary of UK. Its currency, subsidiary's currency is UK. Subsidiary's currency is in dollar. Okay. Forget about the origin. No problem came. No problem came. Subsidiary is in which country? UK. But origin is USA. Means for UK, IBM is a non-resident. Not non-resident Indian, non-resident. And next, HP. Company origin is UK, but the branch is in USA. Branch is in USA. That means when branch is in USA, for USA, HP is a NRI. Sorry, non-resident. Therefore, UK company is banned from borrowing in UK dollar, UK pounds. Dollar company banned to take the loan in dollars because both are non-residents. Huge amount of loans they can't borrow in their home countries. Restriction is there. Therefore, they entered into an alternative arrangement. So, there are restrictions on non-resident borrowing. Therefore, IBM borrowed in IBM. Which IBM? UK's IBM borrowed in dollars. HP. Which HP? USA's subsidiary borrowed. Okay. USA subsidiary means this is the USA subsidiary in UK. This is the UK subsidiary in USA. Okay. So, since the home currency is pounds, they borrowed in pounds. They borrowed in dollars. Okay. Now the problem started. What problem started? So IBM's home country is USA. Origin country head office is not making the borrowing. Subsidiary companies whose currency is UK is borrowing in dollars. There is an exchange risk for that subsidiary. Likewise, HP is not borrowing in pounds. It is borrowing in HP is not borrowing in dollars. It is borrowing in pounds because home currency is in pounds. Now you have to convert. In this case, you have to convert what into what? Pounds into dollar. This you have to convert dollar into pounds and make the payment. Make the payment. Now the problem came. Conversion problem. Risk of conversion started. Okay. IBM in UK. IBM in UK will not have a currency risk when if it borrowing pounds. HP in USA when it will not have a currency risk if it borrows in dollars. Borrow. Already my borrowing is in dollars na. Now you borrow in pounds. How? Swap it. Means HP borrowed in is a transaction. HP borrowed in from its lender. HP borrowed in pounds. This pounds borrowing you take. You take. How much? 10 million pounds. Next. IBM borrowed $15 million. HP wanted to borrow in dollar, because it's in USA na, you transfer this loan to him, dollar 15 million. Okay, next. Who borrowed now? Swap lo who borrowed? IBM borrowed in 10 million pounds na. You have to pay 11%. HP borrowed 15 million na. You have to pay to IBM 8%. This is how the transaction look like. Okay. So how many years is the life of this contract? 5 years life. How many years? 5 years. Clearly he has given here. This is a 5 years term. 5 years term lo what will happen? Let us see. First understood the simplicity here. See here, instead of putting lenders, I again explain this way. IBM borrow 10 million, HP will borrow $15 million. Okay, both will borrow. Really, they borrow. Okay, my loan I will take now, I will give it to you. Loan you take and give it to me. Such that swap happens actually, though it is called as notional principal, in a currency swap transaction of exchanges really happen. So $15 million and 10 million pounds really happen. Okay. Interest payments also will be actually be made. You can't net off the transaction. I will give you an example. In interest rate swap, what will happen? Two parties will be there, X and Y. X pays in fixed, Y pays in to its lender in floating. What we will do? X will wanted to pay in floating. It will take Libar. Y wanted to play in fixed. It will pay 5. Like this we will do. Now really what will happen? Really the transaction what happens is, really we don't receive Libar, really we don't pay Libar. Net off the transactions and only take the overall amount. That means really you will not pay, really you will not receive. But in a swap transaction, really you will receive. Really you have to pay. Reason I will tell you. Here, floating is exchanged to fixed. Floating is exchanged to fixed. Therefore, what will happen? See here. I will write this way. Fixed. From X point of view, if you take, X will pay fixed or pay fixed. Swap la X will pay floating and X will receive fixed. Okay, F. Minus F plus F cancel. X converted its overall interest into floating. Means really it is receiving fixed, receiving float, receiving fixed and paying fixed. Both will be net off. Net off and balance only will be paid. The floating interest only you will be having a net impact. Really you borrowed in fixed, you pay in fixed only. Really Y limited borrowing floating, it will pay in floating only. That you can't change. Overall, if you see after taking the swap transaction, netly you are making a floating payment, that fellow will make the payment in fixed. That means in an interest rate swap transaction, really the payments will not be made for all transactions happening, but here it will be made. Do you know why? 11% is exchanged for 8. 11% is exchanged for 8 here in this case. Here 11 is paid and 8 is received. 11 and 8 can't be set off because there is a difference of 3% here, and moreover this payment will be made in pounds, this payment will be made in dollars. Therefore you cannot make transactions in this way. What you have to do, you have to make a conversion and calculate. How to do? Let us see here what they have done. IBM and HP entered into a currency swap arrangement wherein IBM will pay 11% principal on 10 million in exchange of dollar interest of 8%, 5 years and $15 million. This is an example. What will happen? See here. IBM point of view only we are doing now. Here 0. Here 0. Tell me, how much I will be giving? How much I will be giving? Cash inflow, cash outflow. Two things will be there now. Cash inflow, cash outflow. Listen, I borrowed loan. I borrowed loan means I received 15 million. Are you understanding? From my lender, and I received 10 million. I received first one. If you observe the original transaction, I explained. IBM has borrowed money or not? How much money it borrowed? 15 million. After receiving that 15 million, what we have done? We have given that amount. There is an inflow, no outflow, no initial outflow. Initial outflow. How much initial outflow? 15 million. This is swap cash flows only. Okay, swap. IBM borrowed in dollar. Immediately it used it transferred. transferred this 15 million to HP. Means there is an outflow of cash and inflow, not outflow. And moreover, it borrowed in pounds. There is an inflow. How much inflow? 10 million. Okay. This optional here. You need not really exchange this part of principal. Okay. What will happen? First year one, 15 million dollars loan into 8% interest. 1.2, 1.2, 1.2, 1.2, 1.2. Final year along with 1.2, you will pay back the principal. You will pay back the principal. 10 million. We took the borrowing now, we have to pay interest at 11%. 10 into 11%. 1.1, 1.1, 1.1, 1.1, 1.1. Then you will take. Can I set off both of these? No, because one is a dollar currency, another one is a pound currency. Both are not common exchanges. So, in what original currency IBM has borrowed? Dollar. Convert everything into dollar now. Okay. You have given with a swap rate or not? What is the swap rate given in the question? 1 pound equal to dollar 1.5. Interest rates are given. Okay. Pound interest rate, pound foreign currency means RF, interest rate is given at 11%. Okay, 11%. And dollar is home currency in the given quotation and its interest rate is 8%. 1 plus RD by 1 plus RF equal to F by S. Using this we can calculate 5 years to 5 forward IRPT forward rates we can calculate to convert these pounds into dollar for comparison sake. Okay, we calculated IRPT forward for all the 5 years. We got this forward rates. Okay, these you will use to convert this 1.1 into some number of dollars. We converted it. See here, 15 million is an outflow, 10 million is an inflow of cash. But for that 15 million we have given the loan, we will receive 1.2 million, 1.2 million dollars interest or not. So this is the receipt. Is the receipt. And this is a payment we will make. Why it is 1.6055? What is the first year exchange rate? 1.4595 into 1.1. 1.1 into 1.4595. 1.6055. 1.6055. We converted. So dollar received, dollar equivalent of payment. Netlo you are having a outflow, and outflow and inflow. These all make the payments today na, after 1 year, after 2 years, after 1 year, after 2 years. We calculated present value of all these. Netlo you are having a zero value. Why you are having a zero? Why your receipts and payments exactly knocked off? Because the exchange rate whatever you have taken is as per IRPT forward. Just now I told in the previous question, when the exchange rate is as per IRPT, you will not be having any gain, you will not be having any loss. If in the exam question he said, calculate the swap cash flows taking exchange rate as follows. 5 years exchange rate they have given. Then one particular company will be having some advantage, one company will fall into a disadvantage for sure. Okay. What we have done, summarize everything. Originally I borrowed in one currency, but that is not my home currency. I want loan in my home currency, but I can't borrow because I am an NRI in my home country. Therefore, I will first borrow in my holding company's currency, swap it with some other company who want that currency loan. So I swapped it. So we need to understand. Go to the introduction what I explained for this problem if you didn't understand what. Next question. Take question number 3. Number 3. IBM has taken a loan denominated in dollar for $15 million at 8% interest and wants to convert the loan into pounds because it has now got new orders for export to UK and expect to get a perpetual pound inflows which it want to use to pay the loans without conversion. Same way, HP has borrowed an amount in pounds for a pound 10 million at 11% and wants to convert into dollar denominated loan. Derive a swap. Is a RTP question, a very good question only. Read the question before we start with the solution. Okay, here IBM has taken a loan denominated in dollar for 15 million at 8% interest. Wants to convert loan into pounds because it has now got a new orders for export to UK and expected to get perpetual pound inflows, which it want to use to pay the loans without any conversion. Same way HP has borrowed amount in pounds for a 10 million pounds at 11% and wants to convert into dollar denominated loan. Derivative swap. Previous question they didn't ask for lender original position. I have drawn, but here they have given clearly. Okay, see here what they are telling. The first thing is one thing. I wanted to tell one point. Even if you feel bad, I can't do anything. First thing, currency swaps, currency swaps, currency swaps. Everywhere people listen to currency swaps. Various persons deal in different ways. But the problem is understanding the reality behind why swaps are entered. Okay, why swaps have to be entered? Do you have a clarity as to why swaps are really entered in real world scenario? Why you have to enter into swap contract? I mean currency swap. Why I have to enter? Question will arise or not? This is a classic example to explain why swaps are entered in real life. See here. IBM has taken a loan in dollar. Taken a loan in dollar. Pay interest. Pay interest. At what rate? 8%. Same question. Yeah, last question. Numbers are same. Okay. It want to convert that into pound. How to convert? Original contract can you convert? No. You will only swap to another party and make the net off. Okay, but really capitals are exchanged, interests are really paid. Okay, this is not net off because fixed to floating net off cancellation will be made, but 11 can't cancel against 8, yeah, because there is a 3 gap, and moreover 11% is denominated in pounds, 8% is denominated in dollar. Exchange rates are not same, therefore you can't set off both of them. Next, let us see. Originally I borrowed in dollar 15 million, 8% rate of interest. Now I want to convert into pounds. Why you want to convert? Same problem. That means your company is in UK. Okay, UK la you are a NRI. Same reason. That is first question la reason. This question la reason is different. What they are saying? There is a company. IBM is there. What company? IBM. IBM is there. IBM has to pay its lender $15 million. $15 million. This IBM has exported goods to UK. Exported goods to UK. Okay. Exported goods to UK means it will receive in what? Pounds. When it receive in pounds, what will happen? This pounds has to be converted into dollars. Means there is a conversion problem. If I can convert this loan of $15 million into a pound denominated loan, I have to pay regular interest, I have to pay principal. I can use these pound proceeds to pay this such that I will not receive anything in pound, I will not pay anything in pound. Both my receipts and payments will net off. I will be happily sleeping at home. Are you understanding the point or not? That means exchange risk problem will not come. I will repeat one more time. IBM, USA based company. This company has to pay to the lender $15 million, which it borrowed at 8% originally. Okay, this company made export to UK, for which it will receive in pounds. Since it's a UK company, what it has to do? Convert these pounds into US dollar. This conversion will have a currency risk. Rates may increase, rates may decrease. Anything can happen to the exchange. And moreover, ask bid problem also will come. Spread loss will be definitely be there. They don't want it. How can they negate this? What they have done is, this is a receipt. I will directly use this receipt to make the payment. Therefore, what they are doing, they wanted to swap this 15 lakh pound dollars into some amount of pounds. This has every year interest payment of some amount of interest or not. I will use these pound receipts will come now in my export that I will use to pay this, such that I need not do any transaction in dollar The conversion of pound into dollar question will not happen. I will convert the loan of dollar into pound such that EMIs or anything, interest or principal, I have to pay in pounds, which I will pay using my export receipts, such that I will be having a safe currency transactions happening. This is the intention of this question. Okay, let us see. IBM has taken a loan denominated in dollars. See how it happens. IBM, see the original position first. See the original position. IBM has to pay $15 million at 8%. Okay, but it wanted to convert. So it wanted to borrow in what currency? It wanted to borrow not in dollars. It wanted to borrow in pounds. Really, it can borrow in pounds. Huh? It can't borrow because already it has borrowed. Yeah. I will not borrow two times. I will exchange this 15 lakhs to some other person. What I will do? IBM borrowed 15 million. This 15 million borrowing I will give to HP. Okay. HP borrowed 10 million pounds. This 10 million pounds I will transfer to IBM, such that swap has happened between both of them. Okay, swap has happened between both of them. Now what will happen? You will pay in pounds, I will pay in dollars. This is how the transaction started between HP and this IBM. So now IBM loan transaction of $15 million is no more $15 million. It will be pound 10 million has to pay. Okay, this is the transaction. Let us see the net position of IBM, net position of HP, net position of IBM. First, one by one, let us come. Pay to lender, how much? $15 million. Pay to HP, how much? 10 million pounds. Receive from HP, $15 million. Because you gave 15 million, you took 15 million, you gave 15 million. This taken, given, both will set off 10 million. Next, I will pay interest. I will pay dollar interest of 8. I will receive dollar interest of 8. 80 cancel. I have to pay 11. Technically, my net situation will be pay 10 million loan at 11% out of forex receivable. Means net law how much you have to pay? 10 million at 11%. Forex receivable anyway will come. I will use it to pay. That's all. Means my foreign obligation will be used to pay my foreign receipt, or my foreign receipts will be used to pay my foreign obligation. That means pound will be used to pay the pounds, such that I need not make any kind of conversion. Even this $15 million also, I am not converting $15 million into 10 million pounds. $15 million I am giving it to some other person. In dollars I am giving. Who want a dollar loan? Net position of HP. First, net position of HP, you tell me. I will write here. Don't copy the answers. HP. Pay to lender, 11%. One transaction over. And lender lent money. Oh, sorry, let's not write in percent. First write down the amounts. Pay to lender, 10 million pounds. How much? 10 million pounds. Next. Receive from IBM. 10 million pounds. Okay. Next. Pay to IBM. How much? $15 million. Now, pay to lender, 11%. Receipt from, okay, receipt from IBM, 11%. Pay to IBM, 8%. Minus 11 plus 11 cancel. Minus 10 plus 10 cancel. Net you are paying $15 million at 8%. My original is pound 10 million. Now exchanged and it became $15 million at 8%. This is how this swap will work. That's all. This is how I will transform my assets and liabilities when there is an export or imports. This is a beautiful way of explaining the currency swap. Fourth question also, let us see. BP, Bharat Petroleum. This is another question. It's also an RTP question, but it's a good question again. Fastly, let us complete this. Bharat Petroleum has deposits with Barclays for 10 million pounds at 11%. It believes the dollar is going to appreciate and hence wants to convert its pound deposits into dollar denominated deposits. This is not loan, it's a deposit now. On the other hand, IBM having dollar deposits amounting to 15 million at 8% wants to convert into pound deposit because it has imported capital equipment from UK and it has taken a pound denominated loan to settle the import. Now it wants to convert the dollar deposit into pound deposit so that it can service foreign currency loan with the deposit cash flows without conversion. Explain how a swap transaction can be used to transform deposit of one currency into another. The transformation of assets. Read the question before we go into solution. The question only. Read the question first. Okay. So Bharat Petroleum has a deposit with Barclays in pounds. Pounds how much? 10 million. Pounds 10 million. At how much percent? 11%. Means it has a deposit. Has a deposit. Next. Next one. So bank is a borrower now. 10 million pounds at 11% interest rate. So it will receive 11% by giving money of 10 million pounds with the Barclays Bank. It believes that dollar is going to appreciate and hence it wants to convert its pound deposits into dollar denominated. Appreciation of more dollars will come now. Therefore, I wanted to convert into dollar. On the other hand, IBM has a deposit in 15 million. Okay, 15 million. This is in dollars and want to convert into pound because same imports are there, it wanted to dispose them directly. This is what they wanted to do. Now they wanted to convert. Same question here. This is on a deposit. Borrower is Barclays Bank here. Here there is another person. What happened? Let us see. IBM and BP. First let us see for the BP. Bharat Petroleum, let us see. Bharat Petroleum has a deposit with Barclays with 10 million. When I make a deposit, what will happen? Bank is a borrower. I give loan 10 million. For that, I will receive how much? 11%. I want to make my deposits in pounds. I want to convert into dollars. Convert that into dollars. How to convert? Give these pounds to someone and take the equivalent dollars from them. Okay. So who is in want of pounds now? IBM is in want of pounds. 10 million pounds. Directly give it to IBM. Give it to IBM. This is a scenario. Directly give it to IBM. So 10 million pounds, you don't want, na? You take it, you give it to IBM. From IBM, you take $15 million amount. Such that you will be having dollars, that fellow will be having the pounds. Same transaction, whatever you have seen previously, there is a 1% transaction that happens. Simply, their import and their export happened, and there is a borrowing from your side. Here you are making a deposit. Here you are making a deposit. See here. Transaction looks this. Bharat Petroleum, IBM. Borrower. Now they are not lenders, they are borrowing from us. We gave how much deposit to the borrower? Pound 10 million. Pound 10 million. Interest rate is 11%. IBM has invested. IBM also have its deposits. How much? $15 million at an interest rate of how much? 8%. So both are receipts from us. But we don't want receipt in pound. BP don't want receipt in pound. IBM don't want receipt in dollars. How they can exchange in the swap market? Okay, exchange in the swap market. How they exchange? Let us see. Bharat Petroleum will give pound loan at 11% rate to IBM. It will take dollar loan in exchange at what rate? 8%. This is how they will exchange the transaction. Okay, how they will exchange the transaction. Simply to tell, Bharat Petroleum, Bharat Petroleum will not receive in 10 million pounds, will be receiving in what? It will not be receiving in 10 million pound, it will be receiving in $15 million. They exchanged, they swapped it. Okay, to be very simple and crisp, see here, this is what happened. See here, Bharat Petroleum originally gave a deposit of 10 million pounds to its borrower. IBM has originally made a deposit of $15 million to its borrower at 8%. Both are unhappy with the existing position. They wanted to shift their positions. How to shift? Bharat Petroleum, okay, Bharat Petroleum will be receiving not in pounds. It made a deposit of pounds. It made a deposit in pounds. Now it will make a deposit in dollars. Make a deposit in dollars. How? It will take the position of IBM and it will exchange its position to IBM. Okay, this is what the transaction happened. Net position of Bharat Petroleum. See, yeah, simple question here. Receiving from the borrower. Original borrower will receive. Receive from IBM. From IBM, how much we will receive? 15 million. Pay to IBM. How much we will pay? Our 10 million we have taken, we will pay. So we have deposited 10 million. Okay, we have deposited 10 million and we will be having that amount of 10 million, we will pay it to IBM. So net of the transactions on both the sides. See here. Okay, let us understand and summarize one more time. See here. Bharat Petroleum has already a deposit of pound 10 million. Don't want that 10 million pounds deposit. Will take from the bank. From bank it will take 10 million. It will receive 10 million. Immediately this 10 million it will give to IBM. It gave it to IBM. In turn it will receive $15 million. $15 million it will. This $15 million they will deposit at 8% rate. Okay, so this $10 million at what interest you will receive? 11. This 10 million you have to pay na 11%. 11 cancels. Technically deposited $15 million. Second position. IBM will withdraw the amount from the borrower. 15 million it will get. $15 million it will get. It will give it to the BP. So 15 million received, 15 million paid. Technically 15 million cancel. In turn, what it will receive? $10 million loan it will receive. 8% will cancel. 11% rate kit is deposit. The final transaction you have to show the exam. So this is how the transaction happens. If you understand the third problem, fourth problem, ditto same. This is a borrowing, this is a lending. Sorry, this is a borrowing, is a deposit. Okay. With this, we have completed one segment of this currency swaps. Hopefully, everyone understood all the 4 questions clearly. If you can't understand once, go back and listen because very complicated concept. No? So if you wanted to listen, go back and listen one more time. You can understand, but don't leave the chapter. Extremely important for exam. Another 45 minutes time it will take, or 1 hour max, to complete another point called as another area for discussion called as currency arbitrage. Swap arbitrage is there. Question number 5. This is a May 24 RTP question. May 24 RTP question. This also we will discuss in the class. Very important question. In all the ways possible, we will discuss. Similar question in the latest RTP, another previous RTP one, and there is one popular question in every RTP called as drill dip. This question also we will do. With the completion of these 3 concepts, currency swaps will be entirely completed. From this, only questions will come in examination. That's my guarantee, no doubt. Okay. Thank you very much. Second video will be uploading regarding problem number 5, 6, and 7. That all the areas of currency swaps also will be